Hello, and thank you for joining us to discuss the investment options within the Orthodox Presbyterian Church 403B plan. My name is Benjamin Hayes. I'm a registered investment advisor with Wickley Hewins Investment Advisors, and I also have Daniel Holdridge with me, also another investment advisor with the firm. As you likely know, Wickley Hewins is the provider on this 403B retirement plan. We tackle a number of the investment and financial planning questions that come up in this plan, and certainly enjoy speaking with and talking to pastors to help them make good investment decisions. And that is what this webinar is intended for, is to help you make your investment selection. At this point, you are likely in the enrollment process or considering a change already in the plan, considering a change to your investment lineup. And we hope that this webinar over the next 15 minutes will guide you and give you some good information for making those decisions. And certainly, always feel free to reach out and call either myself or Daniel, or send us an email, or send us a message through the website, the resource guide website. We'd be happy to talk about your personal situation and help you make an investment selection. So with that, let's jump in, talk a little bit about why this is such an important decision. And I want to acknowledge from the beginning that this is a new decision for participants. In the past, the Orthodox Presbyterian Church retirement plan was what's called a trustee-directed plan, where a group of individuals, the Committee on Pensions, would get together on a periodic basis and make these investment decisions, or hire individuals, professionals, to help make these decisions. That was a nice way to go about putting this plan together. But what it didn't allow for were individuals to make decisions that are best for their specific circumstances. So now with this current plan, younger pastors and participants in the plan can be more aggressively invested. And conversely, somebody that is closer to retirement or in retirement can choose to be more conservatively invested than with the past plan. So the key here, though, is we as a firm, Wickley Hewins, want to help you with this decision and make it as straightforward and easy to understand as possible. What we don't want to do is open the floodgates and give you a number of investment options and put the responsibility on you to make the ultimate decision. What we've done, and what you'll see in this plan, are 4 well-diversified portfolios managed by Wickley Hewins, by our investment committee, and that really give great exposure to all different areas of the public stock and bond markets. And the key is deciding which one is most appropriate for you. We go from a very aggressive portfolio all the way down to a very conservative portfolio, and that's why myself and Daniel and other members of our team are available to you to help with that decision. But the key is, let's get you in one of these portfolios, get you investing and saving for retirement, and then as life goes on and as you get closer to retirement, we can revisit that portfolio decision and consider getting a little bit more conservative over time. So here I'll turn it over a little bit to Daniel to talk about kind of the ebbs and flows of the investment markets.
So before we jump into deciding which portfolio may be best for you individually, we think it's important to talk a little bit about investor behavior. And what we're looking at here is a slide displaying how individuals trade on emotion based on what particular segment of the market cycle we're currently experiencing. Investors are oftentimes extremely cautious of markets and a little slow to invest. And what we see here at this end is, as the market starts to go up, investors begin to get a little more optimistic about markets. And then right at the top of the cycle, investors many times are at a point where they're comfortable with markets and they start to invest their money. And as we go through that natural cycle and the market starts to drop, investors start to get nervous, and at the bottom, at fear, here, you see that's at a point where investors a lot of times may start selling their portfolio. So what you experience is that individuals are oftentimes buying high and selling low. Many studies have been done to determine how this actually impacts returns of investment portfolios. And it ranges here, you see, from on this end of the spectrum, almost 1% drop to at this end 2.5% negative return just as a result of moving in and out of markets as a result of that investor behavior. So as Benjamin began to touch on, Whipley-Hewins believes that making those individual investment selections is an extremely difficult task for many retirement plan participants. So what we do is we have constructed 4 well-diversified portfolios here. You see on one end the conservative portfolio going all the way up to the aggressive portfolio. And Whipley takes care of the management of those portfolios. They do the due diligence on the mutual fund managers. They take care of rebalancing all of the different portfolios and allocations within each of the 4. And so we strongly encourage our retirement plan participants to select one of the single portfolios, and we take that investment decision out of the equation for you. We take it out of your hands, and with that, we hope that it reduces the negative impact that we just discussed with investor behavior. So with that, I am going to turn it back over to Benjamin, and he is going to discuss how to make an investment selection.
Thanks, Daniel. So you see here, as Daniel mentioned, 4 well-diversified portfolios. We have on the far right the aggressive portfolio, and if you look at the legend here at the bottom, what's important to note is the aggressive portfolio doesn't have the orange slice of the pie, which is bonds. Bonds tend to be safer investments. They tend not to fluctuate all that much in price from year to year, and that's a key piece of information to note. The aggressive portfolio has no bond exposure. It is developed and put together for some of our younger investors who have time on their side and who would like to push to achieve a higher rate of return. Stocks tend to be more aggressive, but yet have higher expected returns, their actual ownership in a company. So this is one of the most common questions we get from plan participants is which one of these 4 portfolios should I be in? You can see all the way down to the far end, the left side, you have the conservative portfolio, which has over half of its money in that safe asset class of bonds. 60% of it is in bonds. So we want to make this decision as simple and easy for you. We want to avoid some of those behavior gap issues and lower return issues that Dan talked about because of this constant trading and feeling that you need to be managing the portfolio. We are taking that responsibility off your shoulders, but still there remains this very important question of which one of these 4 portfolios should you be in. There is no perfect answer. There is no easy rule of thumb for every individual. Your personal finances are different, but I can, at least as a starting point, give you some direction. And certainly if you want to get into more details, you are welcome to call myself or Daniel. But at a very high level, that aggressive portfolio on the far right, I would argue, is for a participant that has 20 or more years until retirement. 20 or more years until they are going to use these funds for spending, which tends to be the start of retirement. Once you get within that 20-year time frame, again, there's nuance. There's, it really depends on what the market is doing at that point, where the economy is in the U.S. So it's not a hard and fast rule that you need to start making changes at these date ranges. But just, for a general summary, 20 or more years, the aggressive portfolio, 10 to 20 years. So once you're within that 20-year period, from about 10 years to 20 years away from retirement, I'd say you should be looking at the moderate aggressive portfolio. If you're within 10 years of retirement, I'd say the moderate portfolio is, a good spot to be looking as a potential investment. And a lot of our clients, a lot of our retired clients, to be honest, will stay in that moderate portfolio even during retirement, although there is a more conservative option. So if you are at retirement, would prefer to be more conservatively invested, that conservative portfolio is an option for you to make those and to make those changes. We're gonna get into a little bit here at the end of the webinar. Dan's going to run through a demo to show you if you are currently invested in one of these portfolios and the dates that I just gave you that prompted you to consider a change. We'll show you how to do that in just a bit. I'm going to actually back out of the webinar here real quick and go to a page that you just came from to find this webinar, the Retirement Resource Center, and click on under Investment Reports the latest quarterly investment performance report. This will be updated each quarter to show you what these portfolios, how they have performed in recent times. So year to date, 1 year, 3 years, 5 years, all of that information will be available to you for those that have interest in comparing their performance. So let's take, for example, you're in the moderate portfolio. Over the past 5 years, you've had a return of 7.92%. The benchmark, so the same combination of stocks and bonds and U.S. and international stocks that you own, if we just held the index with no fees, how would that have returned? So those comparisons are in there for you, along with at a fund level, comparing your individual mutual funds to their respective benchmark. So just wanted to point that out, that information, that performance information is certainly available to you on the Resource Center. So back to the presentation here. There are 5 frequently asked questions that we receive from participants. So we wanted to address those 5. And these are specific to the Orthodox Presbyterian plan. So hopefully if you've got some questions that you're debating right now, hopefully some of these upcoming 5 questions will highlight and answer those questions.
One of the most common questions that we receive from the OPC retirement plan participants is, does picking multiple portfolios add diversification? What we often have been seeing is that participants, when logging in and making that investment election, have been selecting multiple portfolios, at times making an allocation of their portfolio to each individual one of the portfolios, between conservative and all the way up to aggressive. So we just wanted to briefly address this question. In general, the answer is that picking multiple portfolios does not add diversification. And what I've done here is we've put together a chart to show what picking multiple portfolios, the ending impact that it actually has on your investment allocation. So what we see here is that a participant with the example $100,000 account balance has invested their entire portfolio to the moderate aggressive allocation. And you see the ending portfolio here is that 80% stock, 20% bond allocation. And you see among that $100,000 how it is allocated balance-wise to each of the mutual funds within that portfolio. What I'll do now is I'll select a few different portfolios and we'll take a look at the ending impact that it has on the participant's portfolio as a whole. So we'll switch from 100% in the moderate aggressive. We'll change that to 25% in every single portfolio. And what you find is that here in this actual participant portfolio, there aren't any additional mutual funds added. As an investor, you're not diversified across any other exposure to additional markets. You're just rebalancing the amount of money that's being put in each mutual fund. And by putting 25% into each portfolio, what you find is the ending balance still spread out across the same mutual funds, and you change the underlying asset allocation of your portfolio as a whole. Here in my example, we ended up with 70% stock, 30% bond allocation. Another example would be If an investor were to go to 50% aggressive and say 50% in the moderate portfolio, the ending allocation, again, is just the split between the aggressive and the moderate, and you're back at 80% stock, 20% bonds, which is the exact same, even down to the dollar amounts in each portfolio that would be going to your portfolio if you had just been in the moderate aggressive portfolio. So with that being said, the answer to question number 1 is that picking multiple portfolios does not add additional diversification. We strongly recommend that investors just select one portfolio based on the advice that Benjamin previously touched on, dealing mostly with your time horizon and the years that you have until you will be spending these dollars. The second question that we often get is that, am I required to choose a portfolio? While we strongly recommend that OPC participants do choose a portfolio, it is not a requirement of the plan. When you log on and make a fund selection, you'll see that you can choose at the top across the 4 portfolios: aggressive, conservative, moderate aggressive, and moderate. What you'll also see is that the individual mutual funds that make up each of these 4 portfolios are also available to select from. So while it is not a requirement to select a portfolio, you are able to allocate your account to the mutual funds themselves. But we do, again, strongly recommend that you make a choice to the portfolio, to one of the allocated portfolios. You take that responsibility and put it on our end to do the management of each individual fund.
And if there's potential changes in the future that we and the investment committee for this plan feel are appropriate, by being in one of those portfolios, those changes just automatically happen for you. So it's a little bit more proactive investment approach. We are rebalancing those portfolios, so which means if the stock position goes up, we are selling those stocks to get back down to your target stock allocation. All of that management happens automatically in the portfolios. You need to do those on your own if you pick some of these individual funds. But it is an option, so we want to be sure to let you know that for rare circumstances where that could make more sense. So with that, let's jump to question number 3. And you likely noticed it in many of the individual mutual fund names. There is the word social, particularly in front of DFA investments, although the PIMCO fund, the PIMCO bond fund, is also a social fund. The question we've received is, what does social refer to in these investments? And this is a summary of the different screens that are put in place with these DFA investments. The investment committee, the OPC church, the organization, was clear, and in the prior plan had some of these socially responsible screens put in place on the investments. We don't want to be investing in, in folks that are heavily involved in weapons, alcohol, gaming, abortion, stem cell research. There are more. We picked some of the bigger ones here for this list. The key is that the DFA investments are taking this into account when they're placing buy and sell decisions. We are not owning large positions, any positions in companies that really primarily focus on these industries. So the portfolio is screened for these activities, and even with those screens, there have been discussions with the investment community for many years on whether these screens impact performance. And what we have found, at least with the DFA investments, is that they have been able to put these screens in place and still reach, and in some cases exceed, benchmark performance with their strategies. So we have been very happy with the way that DFA has incorporated their social screens into their investment portfolios. Question number 4, how much do these portfolios cost? Fantastic question. You as an investor want to and should know what the costs of these underlying portfolios are. It has a big determinant on on your end success. I'll zoom back out here. I think it's a little easier to see. Big determinant on your end success is just simply how much are you paying in fees. This little example here is the difference between, I believe, 1% and 2% in expenses over time. Just took a nice, round number of $1 million over 30 years, and you go from 7.9 million in 30 years all the way down to 5.9 million based on a different fee within the underlying investments. So fees matter, portfolio costs matter, and we take that into account. There we go. When constructing your portfolio and picking investment managers, we believe by and large that most investment managers cannot beat a simple index, such as the S&P 500 or the Russell 2000 or MSCI Europe, Australia, Far East Index. These are all just different indices that the industry tracks, and a manager will oftentimes invest their portfolio to try to beat that index. And what you find is they often don't have much success in doing that, and a big reason why is their investment fees. That's why index funds have become so popular. And DFA is a passively invested manager. Not exactly the same as an index fund, but their costs tend to be much lower than the industry average. And if you remember the 4 portfolios Daniel was talking about previously, the conservative, moderate, aggressive, and aggressive, this is the weighted average expense, operating expense ratio of those mutual fund selections. So it ranges from about 0.38% to 0.45%, depending on which portfolio you select. So very low cost portfolios. An index portfolio will tend to run around 0.2%. An actively managed portfolio where managers are trying to pick stocks to beat an index can sometimes run 0.75% up to as high as 1% or more. So we are on the lower end of that scale with the manager selections that we've made. And I guess another subset of this question sometimes I will hear is, should I make an investment in the aggressive portfolio because it's less expensive than the conservative portfolio? And I would say you should not. That your decision on which portfolio to be invested in should primarily be based on your personal situation, how many years you have until retirement, and how accepting you are of having stock exposure. Not at all based on the underlying expense of the portfolio. They are very, very similar regardless of which one you choose. So to wrap up the frequently asked questions, number 5, how much could my account go down in a bad market, is a fantastic question. I had earlier referred to years until retirement as a gauge for which one of these portfolios you should be in. But there's also just an individual question that everybody has to ask themselves, and that is, how comfortable are you? We know that markets go through downtimes and go through bad periods, and the U.S. economy goes through rough stretches. We know that investment accounts will go down at some point. If you stay invested for the long term, we have seen and have experienced very solid returns over the long term. But in a one-year scenario, what could a bad year look like for one of these portfolios? It's important to ask yourself, if you are in the aggressive portfolio, and let's take the example Daniel was working with of a $100,000 account balance, your account value could drop all the way down to $72,000 in a bad year, and we would say that's within reason. That's an expected downside or worst case scenario. And you have to ask yourself, just as a gut check, would I be comfortable seeing my account balance drop that much? Every recession in the past, and our experience shows, if you stick with it, stay invested, you're going to recover that loss, and you're going to continue to go on and make very nice returns. But this is part of that behavior gap, is we need to make sure you're in a portfolio that you're comfortable with, so when that worst case scenario does happen, you're not inclined into selling and making a change. That is the worst time to be making investment changes, is when the market is down. And those are the stats that Daniel walked through of investor returns being 1 to 2.5% lower because of selling in time periods like this. So always a good question before you make an investment portfolio decision. Look at these numbers and just be honest with yourself whether you could stomach downside like we're showing here. So to finish up, I'm going to turn it over to Daniel, and we'll do a quick demo of how you actually make investment election changes online.
If you would like to make a change to your current investment election, the first step is going to be logging into your account at retirement.wipfli.com. And once you get logged into the website, there will be a Manage Investments button on the upper banner. So here you see you're logged in, you see your account balance like usual. Under Manage, you want to go to Manage Investments, and you will want to click on Change Elections. In the case of our sample participant here, you will be able to see that the current investment election is the money market fund. And you'll see the new table of investments. So here in the third column, you see the current allocation to the money market fund. And for example, let's say that we want to switch to the moderate portfolio. What we'll do is we'll enter 100% to the moderate portfolio as our new election. And then it'll show here the new investment elections, 100% to the moderate portfolio. You will click on Next. This screen here where it says transferable balances is essentially asking you if you would like to rebalance the rest of your portfolio to match that investment election. So it's important to keep in mind that the previous screen, you were only making a change to new dollars that are added to the plan. So what this gives you the ability to do is to rebalance the entire portfolio as well as new dollars that are added to that allocation that you select. So we'll click on Yes. And again, you'll get another confirmation showing your portfolio being rebalanced. So for our sample participant here, the previous fund, the previous amount of money that was in his portfolio was $1 in the money market fund. And what we're seeing is that $1 being transferred to our new target of the moderate portfolio. You'll click on Next. You want to click Mark All as Read. And then you'll get a final confirmation screen. The top showing the new investment election for new dollars. And the bottom here showing your portfolio being conformed to that new election and rebalanced. You'll click on Submit, and that is the final step. Your account is now rebalanced to the new portfolio that you selected. So with that, that concludes our investment election webinar. As always, if you have any questions, please do not hesitate to reach out to myself or Benjamin. And thank you for joining today.